Good evening and welcome to the Money Show, the only daily show of its kind which brings you the market's top financial experts to answer all of your financial queries. I'm Avni Raja from the Delhi studio, and joining in from Mumbai is Avan Dubash. Hi Avan.
Hi Avni, yes, we've got a tax special lined up, and today on the show we'll be bringing on board in just a short while from now Mr. Shailesh Haribhakti. He's chairman Haribhakti and Company, to decode the overall tax implications in the budget gone by. In fact, let's just connect with him straight up and start off by talking about the implications of the much dreaded, really, long-term capital gains tax that's with over shares of over 1 lakh rupees at 10%. Give us a sense, Mr. Haribhakti, first up, as to how you've read into this overall announcement and how investors should really look at this.
So, first of all, investors should not panic about the long-term capital gains tax. With the way the grandfathering has been done and the way the indexes have moved under the twin impact of global forces and the announcement of the long-term capital gains tax, the period after which you will have to start worrying about capital gains tax has been significantly elongated. So that's the first very important point that I would like to make. If there's a gain, then you have to consider whether there is long term or short term, and then you have to consider whether tax is payable or not. Having said that, the 10% tax can be a big dampener to your overall financial planning, and therefore, at least for the lower income categories and the modest savers, it is absolutely important that the 10% impact is mitigated to the extent that the government finds it feasible, keeping in mind the fiscal arithmetic and keeping in mind the need to encourage savings. Let us not forget that this year India's saving rate has reached the lowest level we have seen in over 5 to 7 years.
Mr. Haribhakti, we've got a lot of queries specifically on long-term capital gains, among other things. But before we get to the queries, another question, wanted your perspective on. We've seen as far as things like mutual fund flows, you spoke about the savings in India. So just taking that point forward, mutual fund flows have really picked up over the last few years is what we've seen. Now, with this kind of an imposition of long-term capital gains tax of 10%, do you think that that sort of flows would be affected? What your perspective?
Certainly the initial reaction will be that the flows will slow down. But people in India are extremely intelligent. They will keep comparing against the returns from alternative sources of saving and investment. So what are the alternative sources? Is real estate on a net of tax and on a net of foreign exchange loss or gain basis going to deliver a larger return? Is gold going to do that? Is silver going to do that? Is debt going to be a better option? All these questions will be considered by the intelligent investor, and only after the assessment is done that the final answer to the question as to whether the flows will continue or not will be evident. Let us remember one other fact, that the corporate results and the basic performance of the economy has improved significantly in the last quarter. Out of the 10 companies that I'm closely involved with, 7 of them have had a quarter which was perhaps the best quarter in their history. Now that is telling a story to the retail investor that don't lose faith, because what happened earlier was that while the fundamentals were not that strong, liquidity drove the markets up. Now that the fundamentals are getting strong, don't exit the markets and regret that you didn't continue the ride or the wave.
All right, Mr. Hari Bhakti, let's get to all of those questions as well in this with respect to LTCG. Sandeep has reached out to us and he says, with a 10% LTCG tax, are losses allowed to be carried forward and set off against gains? What is your view on this?
The past losses, the long-term capital gains, of course, will be allowed to be set off against long-term cap gains. No doubt about it.
Right. Well, we've got another question coming in from Ravi Shetty. He says, is there any way to reduce the impact of long-term capital gains tax on my portfolio? What advice would you give him?
Well, people have talked about, and this is something that you would be very careful in implementing. Bonus stripping is one of the ideas which has not yet been plugged. A lot of the very seasoned analysts and advisors have said that this is a practice that needs to be curbed. But while it is not curbed, that is the possible antidote to long-term capital gains. So that's something that you might want to consider. The other thing that you need to be careful about is make sure that you constantly have in mind the actual value at which your grandfathering will happen. So you need to be cognizant of the value of each share's market price on 31st of Jan this year in order for you to determine whether the grandfathering is going to help in mitigating your long-term capital gains tax or not. There is no indexation benefit. So it is after the grandfathering is over, 1 lakh exemption, and on the balance without indexation, 10% tax.
I hope we were able to answer your question. Let's get on board. Then another view coming in from question rather coming in. This has been sent in to us from Darpan Patel. And I just want to tell all of our viewers, we have Mr. Hari Bhakti with us. He is joining in for the next 15 minutes. So if you have any tax related questions, implications on your portfolio, what you should do after the budget announcements were made with respect to IT slabs or corporate tax or just in general, please do send them in to us on the Money Show at etnow.tv, or there's a number flashing on your screens. Well, yes, so right to Darpan's question. He says, I fall into the 20% tax bracket with the standard deduction of 40,000 rupees. Now, what will be my effective tax implication and how much more will I be saving? I just wanted to first up get in an all-round view, Mr. Hari Bhakti, as to how one should really be treating the fact that the income tax slabs have not been altered. How are you viewing this? And give us a sense as to what Mr. Patel should do now, saying that he falls into the 20% tax bracket and what his savings could potentially be. So a two-pronged question there.
Sure. So the fact that the tax brackets have not been altered creates a bit of a loss of what they wanted in the minds of the modest income earners, say below an income level per annum of 25 lakhs. And therefore, that has been something that people wanted and expected but did not happen. And therefore, the omnibus 40,000 rupees in the case of a working employee delivers an extremely small 5,000 rupee benefit, but to the pensioner who does not have the ability to claim any of the other reliefs earlier, the full 40,000 comes as a relief. So if you compare the working person, which is the example or the question that has been raised, then the advantage will be 20% of 5,000 rupees, and therefore that's not a very significant advantage that will inure to an existing salaried employee. But to the pensioner, it is 20% of 40,000, which is significant.
All right, there you go. I hope Mr. Haribhakti was able to answer your question as well as give us an implication as to what the no change in income tax slabs really means. Tell you what, let's slip into a break, and as we do that, let's hear it from a market voice. Financials, travel and healthcare are the three big themes to play over the long term. That's the view from Nilesh Shah of Envision Capital, who believes that the three sectors are fundamentally strong and that the government's recent reforms, including Modi Care, will bode well for them. Listen in, come right back, your tax-related queries all being answered today on The Money Show.
It's very difficult to really figure out how this market is going to play out over the next maybe 2 or 3 months. So if you really look at the entire space of financials, and when I say financials, I'm not referring to NBFCs alone, but it's basically a larger category of private sector banks, life insurance companies, stock exchanges. I mean, if you really look at that entire space, and if you really look at how their prices have behaved, a lot of these stocks have corrected more than 20% over the last 1 or 2 months since their highs in December or January. And what we believe is that this is a segment which will witness one of the fastest growth rates. The second big segment to really look out for is travel and hospitality. Again, stock prices have corrected more than 20% from their highs in December, January. And look out for companies again who are leaders and are doing a very, very good job. The third big area, in which I'm not quite sure if there's an immediate opportunity, but over say the next 5 years, healthcare is going to be a very, very big opportunity.
Welcome back. You're watching The Money Show, and we have with us Shailesh Haribhakti to answer all of your tax-related questions. Mr. Haribhakti, before we go ahead with the rest of our questions, another question that I had for you, we were talking about the tax slabs and, of course, the introduction of standard deduction. Do you believe that we are moving towards perhaps a simplification of the tax structure as far as this is concerned? Because earlier you had the medical reimbursements and, the transport allowance, you have to run around for bills. Do you think that this standard deduction that we're seeing in lieu of transport and medical is something that's moving towards a simpler tax structure for individuals? And do you think more needs to be done in that direction?
Absolutely. I think we are moving towards a tax framework which can be implemented using information technology almost entirely. And as the tax systems all over the world start changing and switching, the biggest visible trend is that there is automaticity, there is the blockchain which is being applied to tax administration, and there is simplicity and clarity and rules which can be followed fairly simply. In fact, tax determination in many significant economies is today being done by an internal tax engine which does not leave anything uncertain for the taxpayer. The tax based on your income is determined, you pay it, and that's the end of the matter. That is the regimen towards which we are moving. We have made
so in the same vein, as far as the ease of filing returns is also concerned, what more do you think needs to be done, considering that you're saying that we're moving towards a simplified tax structure as well?
So the important thing is to get rid of all the deductions and all the little bit of here and there reliefs that have been given, and drop the tax rate to what is known to be the average tax rate for all kinds of assessees. If that is achieved, then we will have a simple tax law very similar to what will be achieved under GST, when 4 rates are the only 4 rates that people have to worry about. So we can move towards a parity even in direct tax laws to remove all the clutter and get rid of all these deductions, exemptions, and drop the tax rates and be a little more generous about the slabs, which you were asking me a little earlier about, so that the whole tax framework can move towards automated tax determination and payment.
Okay. That's a view coming in. And, you know, really glad that you're talking, Mr. Haribhakti, about the fact that we are moving to a more simplified overall taxation system. Well, let's get back to the basics. We've got a question coming in from Mr. Shashi Kant, and he says, can you help understand what exactly grandfathering means? So just walk us through what exactly this provision is and how it really works its way into the new provisions for the long-term capital gains tax as well, Mr. Haribhakti.
That's a very good question. Grandfathering means that all the gains that you have made up to 31st of Jan this year are protected. So let us take an example to illustrate. Let's say you bought the shares of company X for 100 rupees a year ago. So let's say we bought it in December 16. So you already have a holding period more than 1 year. So you will then figure out what is the price of that particular share on 31st Jan. Let's say it is 200. So the difference between 100 and 200, which is 100 rupees, will be the long-term capital gain which will be grandfathered. Let us assume that you keep holding this share and you then move into the period after 31st Jan, and let's say on 31st March you decide that you have had enough of a gain and you want to sell it, and let's say that on that day the share is valued at, let us say, 225, then the only quantum on which you will pay tax, and let's say this is the only scrip that you have, 25 rupees multiplied by the number of shares you hold minus 1 lakh rupees will be, and 10% of that will be the long-term cap gains that you will pay on 31st March. That is how grandfathering works. Now there could be various scenarios, but this is the basic idea of grandfathering. Protect the gain that has arisen until 31st Jan 2018.
All right, Ms. Haribhakti, thank you for explaining that in such a simple manner. But our next question comes from Usha Sampath, who says, I'm a senior citizen. Can you tell me how I can make the most of my tax benefits after this budget? Ms. Haribhakti, if you can just outline, what were the main benefits for senior citizens as far as this budget goes, and answer her question.
Sure. So for senior citizens, already there is a differentiated slab which is the same as the previous year, so I won't go into that. That benefit continues to remain, it's important to note. In addition, your interest on bank deposits will now be available on a tax-free basis up to 50,000 rupees. Now that is going to reduce your income. Let us assume that you have fixed deposits of, let's say, 10 lakhs on which you are earning, let us say, 6.5%. 65,000 is your income. From that, 50,000 will be your deduction. So you will pay tax only on 15,000. That's a very big concession. To the extent that your interest does not exceed 20,000 rupees, no tax will be deducted at source on the income that you accrue from bank deposits. That's another important benefit. For insuring yourself, all premiums you pay up to 100,000 rupees will be permitted to you as a relief. And your expenses on medical treatment to the extent of 50,000 will remain protected from tax. So you have the triple benefits of bank deposit interest, rate enhancement, medical expenses, and insurance payment, which will protect you and your income and help you to garner larger net of tax savings.
Sure. Thank you so much, Mr. Hari Bhakti, for taking the time out and joining in, giving us a lot more clarity on what the announcements were in the budget when it comes to tax, as well as answering all of those viewer queries. I'm sure it's been much appreciated. We wrap it up on this leg of the Money Show. Stay tuned tomorrow, 5:30 p.m., where we answer more of your personal finance questions.